Hi, everybody. Welcome to the February 2026 Economic and Market Update presented by Commonwealth Financial Network. My name is Chris Fasciano, and I am Commonwealth's Chief Market Strategist. January was a choppy month for markets. However, all three major U.S. indices were able to end the month in positive territory. Investors dealt with shifting geopolitical risks and concerns about the Federal Reserve throughout the course of the month. However, solid fundamentals helped support markets. The S&P 500, Dow Jones, and NASDAQ all returned low single digits to start the year. While U.S. markets were up modestly for the month, international stocks outperformed once again. This was due in part to rising investor concern about U.S. trade and foreign policy. Developed International was up over 5% in January, while emerging markets were up nearly 9%. This follows a year where international stocks outperformed their U.S. counterparts and could be a sign that investor sentiment remains bullish on foreign equities. Bonds also had a positive start to the year. However, interest rate volatility during the month weighed on returns. The 10-year Treasury yield rose from 4.18% at the start of the month up to 4.24% by month end, with short-term yields ended the month little changed. Despite the rising rate environment, both investment-grade and high-yield bonds were up in January. The Federal Reserve elected to keep interest rates unchanged at the conclusion of their January meeting, which was in line with market and investor expectations. Looking forward, markets expect to see between 2 to 3 interest rate cuts by the end of the year, but the timing of any potential cuts remains uncertain. Toward the end of the month, President Trump nominated former Fed Governor Kevin Warsh to be the next Federal Reserve Chair starting in May. While this nomination is still pending confirmation from the Senate, market reaction to the announcement was muted. While geopolitical factors in the Fed drove headlines during the month, fundamental factors were broadly supportive for markets. We're currently in the middle of fourth quarter earnings season, and so far, companies have once again been beating analyst expectations. With roughly one-third of companies having reported earnings, the average earnings growth rate for the S&P 500 is nearly 12%. This is well above estimates at the start of the earnings season for an 8.3% growth rate and signals continued strong fundamental growth for U.S. companies. Over the past year, company fundamentals have been impressively resilient despite shifting risks, and further improvements throughout 2026 would be a good sign for markets and investors. Despite the solid corporate fundamentals, the economic backdrop remains challenging. The December job report showed that just 50,000 jobs were added during the month, which was a slight drop from a downwardly revised 56,000 in November. The weak labor market is a headwind for the rest of the economy and is weighed on consumer sentiment. Consumer confidence fell to its lowest level since 2014 in January, which could be a concerning sign for future spending. This will be an important area to monitor in the months ahead as consumer spending growth drives the majority of economic activity in the country. Aside from a challenging economic backdrop, there are a number of other risks that investors should also be monitoring. As we saw earlier in the month, geopolitical risks have the potential to drive headlines and move markets in the short term. Political uncertainty rose to start the year and is expected to remain a key risk as we approach midterm elections towards year-end. Despite these risks, however, the most likely path forward for the economy and markets is further growth and appreciation. Over the long term, fundamentals drive markets, and we've seen continued improvement on the fundamental front for a number of years now. With analysts calling for continued earnings growth and companies outperforming analyst estimates, markets should continue to benefit from these improvements, even if short-term risks and volatility remain. That's it for this month's update. I'll be back next month to walk through whatever the markets throw our way. Take care And thanks as always for watching.